Okay, our next panel discussion will be moderated by Dan Yu of Eisner. He will focus on emerging economic, investment, and tax trends that will impact the management of your family wealth. Dan?
Thank you, Marie. We're going to switch gears here and speak from the perspective of an end investor, be it a family enterprise or high net worth individual, and take the perspective from an economist, a tax professional, and an investment consultant. Today on the panel we have Dr. Walter Kemses, Barbara Tavey, and Mr. David Hammerstein. We'll have a round of initial questions where we're going to review where we were 15, 18 months ago, what we've learned, and then come back and take a look, a forward look, on where the economic landscape is going forward. Dr. Kemses, why don't I start with you? Can you give me your perspective from an economist standpoint? And Dr. Kemses is the chief economist at Moffitt and Nichols, and also is a consulting economist with Rosenblatt, excuse me. Dr. Kemses, can you give us your perspective from an economist standpoint of where we were 15 months ago? And what are some of the learnings that we've come through that crisis?
I guess if we look back about even a year ago, it was pretty scary as we watched the U.S. and pretty much the world economy circling the drain. And the reason we were in that position wasn't so much Lehman Brothers. That was probably the watershed event that got us there. But for a number of years, we had an excessive buildup of leverage in the household sector as well as in the corporate sector. The culprit being what people talked about at the time being the conundrum of low bond yields. You might remember bond yields never really picked up very much. And this is because China has been growing a lot economically through exports to Europe and the US. But they never bought their own currency back, and those dollars found their way into the fixed income market, lowering interest rates and instigating a lot of investment in real estate. And by the time we were approaching the Lehman debacle, it was pretty clear that we were facing a potential debt deflation cycle, or something you might know more popularly as a Great Depression. So when we get to the point where Lehman Brothers failed, it was simply the watershed event that accelerated the negative trends that were in place. But what we were telling people at the time was that pretty much the only safe place to be would be where there was inelastic demand for goods, things like food. And particularly in the port space where my company operates a lot, this did turn out to be the only safe haven. Everything else has been hit pretty hard. Worse than the economy has been United States trade. The West Coast ports, which bring in a lot of goods from Asia, their volumes are still down over 30% from a year ago.
Can you give us a little bit of perspective of what has been learned through some of the pains that we've suffered?
Well, there are a couple of key things that I think we've all learned. We kind of were aware of them, but now it's pretty obvious. But the globalization of finance, which has been well ahead of the globalization of the world economy, meant that any problems of a large economy like the U.S. were going to be instantly propagated around the world. And pretty much, through good fortune, the Asian banks and the Latin American banks didn't own a lot of U.S. real estate or weren't geared to it, but everybody else was. The economy of Iceland is decimated. They were very exposed to this, as was Sweden. Right. And the reason for this is that not only is the financial industry more globalized than the global economy, but the policymakers are lagging behind the curve. There is very little coordination amongst policymakers, and even today they're still debating things that shouldn't be a debate. But we have to be concerned that the policy coordination around the world is still lagging the global economic reality. And the reason it matters so much, in particular, I'm just going to take it back to the space that I operate in a lot. What we learned is that the credit crunch in the U.S. had the same effect as the Arab oil embargo of the 1970s. Credit is very important to the world economy, and there was no credit to permit trade to continue to take place. And this is how the financial sector debacle then became a global real economy crisis.
And it hasn't really improved, even though interest rates are at all-time lows. The access to capital, banks are just not lending, not allowing that refinancing to occur, especially in your industry as an example. Is that true?
That's absolutely correct. As the global banking industry was consolidating, we went from 15 banks that provided world trade credit down to 10. And of those 10, 9 of them, well, they really weren't capable of extending loans. And even right now in our economy, one of the biggest problems we face is that the banking system still doesn't have enough Tier 1 capital or the regulatory capital required to extend loans. And this is a barrier to economic recovery.
Excellent. Thank you, Dr. Kemses. David, I'd like to get your perspective as a investment consultant. David Hammerstein is at Yanni Partners, a division of GBC Investment Consulting, LLC. David, can you share with us, when you were helping your clients through this crisis, a little bit about how we handled that and what was learned through that process?
Several years ago, Alan Greenspan gave a speech, and he mentioned that history does not deal kindly when the price of risk falls too low. And we actually saw that in 2005 and 2006. The price of risk got to be very low, and that led to a lot of unfavorable investment practices. The price of risk was low in the sense that you weren't compensated for taking risk. Credit spreads were very low. The Treasury yield curve was flat. Options, the volatility implied in options prices was very, very low. And dividend yields were low. So and credit was readily available. You could get credit on very easy terms with only lax covenants. And that led to a lot of unfavorable practices. It led to the formation of hedge funds, organizations that had no business being hedge funds because they didn't have the proper management skills. That led private equity firms to buy companies simply on leverage without a thoughtful business plan to turn around the operations of the company. We were advising clients to diversify properly and very broadly, but we were also working with them to go through a formal investment planning exercise where we looked at the risks of assets in the various markets and developing a comprehensive investment solution recognizing those risks.